Pause for a moment. 4.4 billion ounces is not a normal number. It's not millions, it's billions. And it carries a weight that could crush even the largest banks on Earth. What happens when two of the most powerful financial institutions owe more silver than the world can produce in years? When vaults are empty, algorithms are flashing red, and a 150-year-old chart quietly predicts this exact year. This is not about headlines. It's about a delivery crisis, a solvency problem, a reckoning that could reshape markets forever. Because once you understand the math, there's no going back. Welcome to Boring Currency Index. If you've seen financial cycles rise and fall, if you remember when contracts actually meant delivery and numbers actually meant truth, then this channel was made for you. If you value serious analysis over hype, quietly subscribe, not for excitement, but to catch the warnings most people will ignore. And before we dive deeper, tell us in the comments from which city or country you're watching this, because what's about to unfold is not limited to Wall Street, and it will affect markets globally. The leaked ledger surfaced 48 hours ago. Analysts are staring at numbers that defy comprehension. Bank of America and Citigroup may be sitting on a combined liability of 4.4 billion ounces of silver, a figure so enormous it overshadows the entire annual global production. For context, the entire global mining industry produces about 800 million ounces of silver per year. These banks have allegedly sold more than 5 years' worth of supply, before it even exists. This is the textbook definition of a naked short position. Selling promises you cannot fulfill. The vaults are empty. The registered inventories stand at a fraction of what is needed. The U.S. Mint has suspended operations. London's vaults have been depleted. Every attempt to cover these positions is blocked by mathematical reality. When silver's price surged from $50 to $90, the banks absorbed nearly $160 billion in paper losses. Their aggressive price suppression was not profit-driven. It was survival-driven, an attempt to manage an uncontrollable liability. Every short position in this scenario is a future guaranteed buyer. Bank of America and Citigroup are no longer sellers. They are forced buyers of the same silver they promised to deliver but do not possess. The market's reaction is immediate. Violent crashes, flash dips, and unprecedented backwardation. Physical silver holders are signaling a shortage the paper market cannot ignore. This is the crisis that will define 2026, a reckoning of historical proportions. The problem with paper markets is not that they exist. It is that they are often mistaken for reality. In the silver market, this confusion has been building for decades. On screens, silver appears abundant. Contracts trade in enormous volumes. Liquidity looks deep. Prices move smoothly, as if supply can always be found. But behind the numbers is a physical system that does not move at the same speed. Silver is not an abstract asset. It is a material. It must be mined, refined, transported, stored, and secured. Each step introduces limits that no amount of financial engineering can remove. Unlike currencies or digital securities, silver cannot be created to meet demand. This is the constraint that defines the current crisis. In a typical futures market, contracts are used for price discovery and risk management. Most participants never intend to take delivery. Positions are opened and closed in cash. This works as long as only a small percentage of contract holders request the physical asset. The system depends on that assumption. But when the scale of paper claims grows too large, the assumption becomes fragile. Exchange inventories provide a clear illustration. The amount of registered silver available for delivery is a fraction of annual global production. It is also a fraction of outstanding paper claims. This imbalance is not new, but it becomes dangerous when confidence weakens. If even a modest portion of contract holders decide they want metal instead of cash, the system strains. Recent developments suggest that this strain is no longer theoretical. Physical premiums have widened across multiple regions. Dealers are quoting longer delivery times. Some government mints have suspended sales entirely. These actions signal one thing: physical supply is tight. At the same time, industrial demand continues to rise. Silver is essential for electronics, solar panels, medical devices, and advanced manufacturing. Unlike investment demand, industrial demand does not respond quickly to price. Factories cannot simply stop using silver because it becomes expensive. They need it to operate. This creates a structural conflict. Financial markets assume flexibility. Physical markets operate under constraint. The difference becomes critical when large short positions exist. A short position assumes future availability. It assumes that at some price, supply will appear. But in a market where production is capped and inventories are limited, higher prices do not immediately produce more metal. They simply reveal scarcity. This is why silver behaves differently from many other commodities. Gold, for example, has large above-ground stockpiles. Most of the gold ever mined still exists and can re-enter the market. Silver does not share this characteristic. Much of the silver mined over the last century has been consumed by industry and is not economically recoverable. As a result, the visible stock of silver is smaller than most investors assume. This reality undermines the logic of extreme paper leverage. When contracts multiply faster than physical supply, the market becomes vulnerable to sudden shifts. Price stops reflecting balance and starts reflecting stress. For banks with large short exposure, this environment is hostile. Rising prices increase losses. Tight physical supply limits exit options, and any attempt to close positions risks pushing prices even higher. This is why recent price volatility should not be interpreted as normal market behavior. Sharp declines followed by rapid recoveries often signal forced activity rather than free trading. They suggest participants acting under pressure, not conviction. In such conditions, suppression is not a strategy, it is a response. It buys time, but it does not resolve the underlying imbalance. Each intervention leaves the structure weaker than before. What emerges is a market split into two layers. On one layer, paper contracts continue to trade, giving the appearance of normal function. On the other, physical metal becomes increasingly difficult to obtain. The gap between these layers is the warning sign. When paper claims and physical reality drift too far apart, reconciliation becomes unavoidable. And when it arrives, it rarely favors the institutions that assumed the gap could be managed indefinitely. In the next part, the focus turns to the mechanism of failure itself, and why efforts to control this imbalance may be accelerating the very outcome they are meant to prevent. Failure in financial systems rarely arrives suddenly. It tightens slowly, almost politely, until movement itself becomes dangerous. By the time observers notice extreme volatility in silver, the outcome is often already decided. Sharp drops and violent rebounds are not signs of a healthy market correcting itself. They are signs of participants operating under constraint. Someone, somewhere, is being forced to act. Large short positions behave very differently from ordinary trades. When prices rise, losses do not increase gradually, they compound. Every additional dollar adds pressure, not just financially, but structurally. Margin requirements rise, risk models adjust. Liquidity evaporates precisely when it is needed most. For institutions carrying massive exposure, this creates a narrowing corridor. There are fewer ways out with each price increase. In theory, a short seller can close a position by buying back the asset. In practice, size matters. Attempting to purchase large quantities in a tight market drives prices higher. The act of exiting becomes self-destructive. What was once a manageable position becomes a feedback loop. This is where suppression enters the picture. When prices suddenly fall without a clear fundamental trigger, professionals look for motivation, not explanation. These moves are often described publicly as profit-taking or technical corrections, but internally they are viewed as risk management events. The objective is not to win, it is to survive. A rapid price drop reduces mark-to-market losses. It eases margin stress. It buys time. For a brief moment, balance sheets breathe again, but this relief is temporary. If the underlying supply problem remains, the price pressure returns. In return, it does. Each rebound carries a message. Physical buyers step in quickly. Industrial users, long-term holders, and strategic accumulators do not wait for perfect pricing. They respond to availability. When metal appears, even briefly, it is absorbed. This behavior exposes a critical asymmetry. Paper sellers can create unlimited supply on screens. Physical buyers cannot create supply at all. They can only accept or reject what is offered. When acceptance becomes immediate, it signals scarcity. At this stage, counterparty risk enters the conversation. Futures contracts are promises. They rely on the assumption that the other side can perform. When confidence in that performance weakens, participants behave differently. They shorten time horizons. They demand higher compensation, or they exit the system entirely. This shift is subtle at first. Lease rates rise, delivery times extend, terms change. But these are not isolated developments. They are symptoms of trust being repriced. For banks with large short exposure, trust is essential. Their positions assume that contracts will be rolled, settled, or netted without physical delivery. If that assumption fails, the structure collapses. This is why backwardation matters. When spot prices exceed futures prices, the market is signaling urgency. It is paying a premium for immediacy. In non-perishable commodities, this is abnormal. It reflects a preference for possession over promise. At the point the trap is fully formed, to exit, banks would need to acquire metal, but metal is scarce. To wait, they must maintain margin, but margin demands rise with price. To suppress price, they must sell paper, but selling paper deepens future obligations. Every option worsens the next. This is not a trading error, it is a structural deadlock. The system has created obligations that exceed its ability to resolve them smoothly. And when systems reach this state, resolution is no longer a choice. It is imposed by events. In the next part, the analysis steps back from mechanics and looks at history, because situations like this do not appear randomly. They follow patterns. And according to one of the oldest market cycles ever recorded, this moment was not unexpected at all. When history intersects with mathematics, crises stop being random. They become inevitable. The silver market has entered such a moment. All the signs, physical scarcity, paper leverage, escalating premiums, and abnormal lease rates point to the same conclusion. The system cannot continue as it has. The very laws of supply, demand, and arithmetic are now asserting themselves. For Bank of America and Citigroup, the situation is no longer hypothetical. Their short positions, allegedly totaling 4.4 billion ounces, represent obligations the world cannot deliver. Every ounce they promised exists only in paper. Attempting to cover it through purchases would not only fail but amplify losses exponentially. Prices would spike uncontrollably, and no suppression could stop it. The solution these banks will likely pursue is embedded in the fine print of futures contracts, force majeure. This legal mechanism allows a counterparty to declare that delivery is impossible due to circumstances beyond their control. Traditionally, it applies to natural disasters or acts of God. In this case, the uncontrollable circumstances will be the physical market itself. When invoked, force majeure transforms the landscape overnight. Paper holders expecting delivery will receive cash settlements instead, often far below what the real silver is worth in a constrained market. Meanwhile, the street price of physical silver will soar, reflecting actual scarcity rather than financial claims. This is the decisive moment when paper markets fracture from reality. History provides an eerie guide. The Benner cycle, a chart drawn in 1875 by Samuel Benner, has predicted major market turns for over 150 years. According to this cycle, 2026 was circled as a year of peak commodity prices and financial turbulence, a period when hard assets like silver would outperform paper investments. The pattern is clear. Capital rotates from paper to physical assets at the top of cycles. This means the short positions these banks hold are betting directly against history itself. They are attempting to suppress prices and extend the life of the paper system just as the natural rotation of capital accelerates. Every move to delay the inevitable only compounds the structural risk. The implications extend far beyond silver. Banks of this size are considered systemically important. Their collapse would ripple across derivatives, credit markets, and international finance. The United States Treasury and Federal Reserve are already aware of the exposure. Emergency meetings, mints suspending sales, and algorithmic alerts signal that authorities understand the stakes. But even intervention cannot create physical silver where none exists. The solution will be financial, not material, which only changes the allocation of risk, not the underlying scarcity. For investors watching this unfold, one principle is paramount: possession matters. Physical silver, gold, or other hard assets cannot be replaced by paper promises. Those who hold real metal are insulated from the collapse of paper derivatives. Those who rely on contractual claims are exposed to the legal and financial maneuvers that will follow. The story of Bank of America and Citigroup is more than a financial warning. It is a lesson in structural limits, human overconfidence, and the consequences of ignoring historical cycles. When obligations exceed reality, when leverage exceeds supply, and when cycles reach their predetermined pivot, the market enforces its own rules. 2026 will not be remembered as a year of incremental shifts. It will be remembered as a turning point, the moment when the paper system fractured, the real economy reasserted itself, and the great transfer of wealth from promises to physical assets began. The banks are trapped by mathematics, constrained by history, and challenged by scarcity. The rest of the world now watches, understanding that in this moment, the rules of finance and the laws of physics converge, and the outcome is no longer negotiable.